What up, guys? Jay Manchin here, back with another quick hitter. I thought I'd make this video in response to the hot CPI report that came out today on the day of shooting, is Wednesday the 10th. And this CPI report confirmed some of these thoughts, kind of most of the thoughts that I've been sharing with you guys over my last couple of videos in terms of when the Federal Reserve is going to cut rates, why, and what risk are they aware of / want to avoid. I'm going to break that down for you right now and give you an update on when I think the Federal Reserve will actually cut rates. All right, let's jump right into it. So the CPI headline number came in at 3.5% today, and core CPI came in at 3.8%.
Year over year, CPI core 3.8, hotter than expected,
which is confirming that inflation has been sticky to the upside, especially when it comes to core inflation, and that's on the CPI and the PCE. But we're going to get PCE data on the 26th of this month. And so we still have some time. And so investors and talking heads are putting a lot of attention on this hot CPI report. Now, in my last video, I described the two risks that the Federal Reserve are completely aware of. One, they would prefer over the other. Now, the first one being cutting rates too soon. The second one being cutting rates too late. If you cut rates too soon, you risk reigniting already sticky inflation. If you cut rates too late, you risk putting downward pressure on the labor market, pushing it into a recessionary territory. One thing that Jerome Powell, the Fed chairman, has been saying is that he's looking for more evidence that inflation is moving down sustainably to their 2% target. And a little Easter egg for you, he's been saying our longer term objective. And so that should tell you that it's going to be some time before inflation actually gets down to 2%. Now, if you've been watching my videos, I'm not telling you anything that you don't already know. Now, the risk that they would prefer is reigniting inflation versus putting that downward pressure on the labor market. But before I go into when they'll cut rates, let's jump into this CPI report here super quick. So as you can see, circled in black, that's the headline number that I mentioned. Down circled in red, and I put red for a reason because it's bad. That's the core CPI number at 3.8%, which is actually pretty crazy that we've seen an uptick. And this is all while the unemployment rate actually went down from last month from 3.9 to 3.8%. Now, I want to draw your attention down to that yellow circle where you see services and shelter circle. The reason I circled those is because those are the stickiest portions. And I've been talking about this for a long time, guys. These are the stickiest portions of the CPI and PCE. Now, as we know, we're a service-based economy, so I don't expect any disinflation, meaningful disinflation or relief in that service sector. And I've been saying this for a long time as well. I don't expect to see any in the shelter portion as well. And even if that shelter portion were to catch up with real housing data, it'd still be very sticky. So unless there was a housing crash, which I don't think we're going to see, that is going to remain elevated. And because we're a service-based economy, that's also going to remain elevated. And so transportation services, any type of service you can think of, to be honest, they're going to keep moving higher. In fact, there was just a press release today about the New York transportation fare is jumping up 15%. And you're probably going to start to see that around the country a lot more. And so if I had to call it, that is definitely not enough evidence that inflation is sustainably moving down to their 2% target. In fact, it's the opposite. And this is causing a lot of analysts, a lot of investors to believe that they won't cut rates at all this year. I'm still not in that camp. And you can see by the Fed CME tool that the probabilities for a Fed rate cut in June has also dropped from 40%, over 40%, down to 17%. And so the market's coming to terms that a June rate cut would definitely have been too early for the Federal Reserve, as we would not have had enough data. And now we've confirmed that we don't have enough evidence that inflation is moving down, or we're seeing that disinflation that the Federal Reserve wanted to see. And so, yeah, you're seeing people project that the rate cuts would just be pushed back. Now, we all could be totally wrong and they still cut rates in June. I just don't think that would make sense, because you would definitely just make inflation jump through the roof once again, which we don't want. None of us want that. And some are even saying that the Federal Reserve, they're not worried about being politicized anymore, and they're going to cut in September, which I think is not the most opportune time, Because the one thing you don't want to do is seem politicized as the Federal Reserve, when since inception, you wanted to create that perception of you being completely separated from government or fiscal policy. I still think the most opportune time for the Federal Reserve to cut rates is July. Although I still think inflation is going to remain sticky, it's going to take us to like the end of 2026 to get down to 2.5% on the CPI, on the PCE. Whatever metric you want to use, it's going to take a couple years. So we still have a long time. And so although I could be wrong on this July rate cut, I just think it's the most opportune time because they've already projected 3 rate cuts for 2024. And for them not to do it, it's almost like a rug pull for the market. And the Federal Reserve, when they kind of put pride at this point into forward guidance and into communicating transparently with the market so that way they don't spook it, July seems like the perfect time to do so. Because although, like I said, I think it'll be sticky, we may see a bit more relief on these next few reports. And the PCE coming out on the 26th, we may see some relief in that as well. Just a little bit. Not meaningful, but enough to where the Federal Reserve will feel comfortable cutting rates in July. But let me tell you, June is not happening. And if we were to keep rates elevated where they are now, it's just going to hurt the labor market. It's like if it was a two-sided sword, the second risk of the labor market tanking, that's the serrated side of the blade or the sword. And I think they would rather deal with the smooth side at the moment. So they're still in this very, very delicate position in which if they make the wrong move, something can go extremely wrong in either direction. And with the stock market at all-time highs, the last thing the Federal Reserve wants to do is send that in the opposite direction. But it's like because yields have been moving higher, as we've also been talking about here for a very long time, that could put downward pressure on stocks in the medium to long term, just because that competition between stocks and bonds will start to brew again. Because with bonds, now, because they're undervalued or the value of those bonds are decreasing, the yield's going higher, now investors can lock in a higher yield and at maturity get some nice gains on those bond holdings, on those US Treasury holdings. And so they have to take some type of action this year in 2024. Does it make sense to hold rates where they are? If they were to turn back, like I said, that could be a rug pull. It's the last thing they want to do. So I'm sticking with July. And although I'm saying July, I still think by cutting in July, you actually still risk reigniting inflation because I've said it 10 times in this video already that inflation is going to be sticky. I feel like I've been saying sticky a lot today, but it's true. But by waiting just a little bit, maybe you won't reignite it as much. And if someone were to tell me that there is no reason for the Federal Reserve to cut rates this year, I would slightly agree. So all in all, rate cut coming in July. You may see reignited inflation just a little bit, not too bad, but at least you won't send the labor market spiraling out of control. Plus, they have to do something at this point. It's too late. They already said it. But anyway, I hope you guys enjoyed this quick hitter. As always, let me know what you think in the comments. If you find this type of content valuable, book a free strategy session, link in bio. And guys, I'll see you on the next one.